You're probably not going to find a more impressive blue chip stock in the country than the one I'm going to talk about today. It has 20% compound annual returns over the last 10 years. It has double-digit returns on invested capital. Its balance sheet is absolutely outstanding, and it's going through a 16% dip on its latest quarterly earnings report, which is why I'm getting a lot of feedback to cover this company. So I'm going to go over it in this video. Before we start, remember I have that report on my top 4 stocks down in the description. It's the top 4 positions in my portfolio, my allocation, my thesis, my main risks, things like that. It takes you just seconds to sign up, and you can grab it absolutely free. But the company I'm going to be talking about today is Thomson Reuters. This company has very, very quietly put up some rock solid returns over the last while, and is probably one of the most underrated companies in the country. So in this video, I'm going to go over the bull case, the bear case, and my overall thoughts on the company, whether or not I think it's a buy on the dip. And by the end of the video, I hope to give you a better idea as to whether or not this company could be right for your portfolio. So let's get started. So what exactly is Thomson Reuters? A lot of people just believe that this company runs the Reuters website, but this is actually a very small segment of the business. I believe it's under 10% of the total business. The company does have 5 core segments of revenue generation, but what they really focus on is the big 3, they call them. This would be lawyers, any sort of legal entities, accountants, and then corporations. So in a nutshell, what this company is a software company that owns massive amounts of databases of content. And what it will do with that content is kind of curate it and make a workflow and a platform so that, let's say, for example, lawyers can go on and look at previous cases, case laws, legal documents, legal structures, depending on which country you're in, things like that. Accountants will be looking at tax laws, systems to improve the efficiency of the overall tax firm in general. And effectively what these law firms, what these accountants, what these government entities will do is pay Reuters for a subscription to access this data and to make it easily accessible via the workflows that they generate. Now, if there's one thing that all these firms have, we're talking accountants, lawyers, government entities, is money. And although the total addressable market is not all that big, when we think of the amount of money that these firms generate and the amount of money that they're willing to spend on software like this, it makes the business very, very lucrative. Although they're not targeting a wide market, the market that they are targeting is willing to pay top dollar. So the first bull case for this company would be the situation of their subscriptions. First off, the renewal rates are crazy high. They're often in excess of 90%. And these subscriptions also have very high switching costs. This is exactly what you want from a recurring revenue business. You want to make it so that the product is so good and so integrated into these businesses that the actual cost to switch to something else is just not feasible. We are not dealing with simple businesses here. We are dealing with very complex businesses that have a lot on the line. So they are not going to be willing to retrain their employees, swap to another platform that might offer, yes, some data, but not as accurate, not as comprehensive as something like Thomson Reuters. So they stick with the platform because you do not want to be making mistakes in the area of law, and you do not want to be making mistakes in accounting when you have a lot of other people's money on the line or any situation like that. So these companies are willing to spend the money for access to top-notch data and curation. Now, I know a lot of people, maybe they browse ChatGPT for legal advice, for accounting advice, and they kind of think that a model like this could be disrupted. You browsing this type of stuff and a major corporation, a major law firm, accounting firm doing so it's a much, much different situation. You are a person looking for some tax advice or legal advice. You're not dealing with corporate clients who are handling hundreds of millions of dollars. They are just not going to go to ChatGPT to find legal advice for their clients. So the second bull case would be the database of content. The company has been building the database for decades, which makes it very, very hard to replicate. And in addition to this, the workflows that it generates and the platforms that it runs, it's clients have trained their employees on these systems for a very long time. They're very integrated into the business, which again adds to that stickiness of the business itself. If somebody were to swap to another platform, it better be worth it cost-wise. They're going to have to train their entire company again on a new system, which is a pain. It costs a ton of money, and it leaves room for errors in, again, areas like law and accounting that you simply cannot have errors, or else you will cost your clients, in the terms of the companies that use Thomson Reuters, an excessive amount of money. So the third bull case would be the integration of AI into the company's platform. So the company is developing AI assistants on both the legal side of things, the accounting side of things, pretty much the entire business. But the main thing here is their artificial intelligence is built on their internal content system. It's not a broad-based AI search assistant like you would see with a ChatGPT, a Gemini, things like that. The company is currently planning to spend around $200 million a year on artificial intelligence, and it is actually stated it is willing to spend $10 billion on potential acquisitions through 2027 to increase its exposure to AI. If they can create AI assistants that get companies access to this information, clients to this information, those clients will then save billable hours, which will ultimately save their clients money and will actually open up more hours for the firms to acquire new clients, which kind of creates a flywheel for the clients of Thomson Reuters. They can reduce their billing hours, which adds more clients, which adds more money. And as Thomson Reuters improves those AI platforms, it will continue to amplify this, and clients will continue to see more value in these subscriptions. And finally, the company's margin profile is outstanding, and its balance sheet is outstanding as well. Long-term debt comes in at around $2.8 billion for a company with a market cap of around $110 billion, and they generate trailing 12-month free cash flows of just under this. So effectively, the company could eliminate its entire debt profile with just 1 year's worth of free cash flow, which creates a lot of flexibility in terms of acquisitions, in terms of integrations, when it comes to AI, capital expenditures, things like that. And in terms of margins, they have operating margins of nearly 27%, which does put it up there with some of the major US technology companies. So the bear case. Before AI came around, the company's moat was very obvious. Now there are some questions as to whether or not additional companies can create databases and scale with AI to the point where Thomson Reuters platforms might be under a little bit of pressure from competition, especially when we think of these smaller clients that are doing more day-to-day tasks. Again, I don't see a major company, a major law firm that is just going to swap from a platform like Thomson Reuters to a cheaper alternative unless they are absolutely sure that it is going to provide the exact same quality. I don't see that anytime soon, but the smaller clients that are doing more smaller tasks, things like that, utilizing Thomson Reuters for not the most extensive things, they could find opportunities in cheaper platforms that are built out to scale faster and to be offered at a cheaper price. There was not a lot of competition in this business in the past, but there is certainly some competition coming now. The company will need to continue to utilize AI and invest more into artificial intelligence efficiently. And I say that with a lot of emphasis because you have to be doing it the right way to not burn a lot of cash, but they need to be doing this in a way that saves their clients time, that saves their clients money, to the point where it is still not worth it for their clients to churn away from something like Thomson Reuters and go to a cheaper alternative that offers the same product. This has not happened yet, but there is the potential for a lot of issues in the future. Again, we're only 1 or 2 years into this AI surge, and we've seen just how far an LLM like ChatGPT has come. It is crazy advanced now. So what will it look like in 5 years? So the third bear case is valuation. This company does trade at a premium valuation, and over the last while, it has been justified, but now there's a lot of questions in regards to that premium because of the artificial intelligence and because of a lot of soft earnings in Thomson Reuters last quarter. Is trading at 41x trailing 12-month free cash flows and 40x expected earnings. This is more expensive than most big tech names in the United States, and it does not grow as fast as those names. Yes, the business model is stickier, but it's just not as fast growing of a company. So at this point, one of the main reasons I think the drop is happening is the market is starting to get spooked on this whole AI situation. The company's earnings and margins are likely to take a hit because it is going to be ramping up capital expenditures to invest in artificial intelligence, and it's going to be spending a ton of money on acquisitions that are not guaranteed to work out. It is very difficult to see the return on investment we are going to get from artificial intelligence rollout, and if the money ends up being ill spent, it will have a big impact on overall shareholder returns. So if you are going to be buying this company or you currently own this company, you need to be paying attention to those organic growth rates among the big three business models. This is going to be absolutely key moving forward. You're also going to need to pay attention to how many of those clients are actually rolling out and integrating into Thomson Reuters AI systems. If these numbers lag or are less than expected, I would imagine there's going to be a ton of pressure on the share price because a lot of investors might start to think that the money that the company is spending is not really going to turn out into very high profits for shareholders. If they roll out $200 million into a bunch of AI infrastructure and it doesn't really increase the user experience for a lot of these clients, it is probably just going to result in higher churn and a lot of wasted cash. So overall, Thomson Reuters is pretty much your classic compounder. It's got that recurring revenue stream. It has ridiculously high renewal rates, which creates a very consistent cash flow basis. That sticky business model where a lot of these companies are so integrated, like their business is so integrated into systems like this, is very hard for them to move away from the platform and into alternatives. So this does create an element of pricing power for something like Thomson Reuters, which should fuel growth in the future. And the large upside here is primarily from the fact that the company's investments into AI will, again, improve their interfaces, improve their user experience, and ultimately bring more clients on board. That said, the company's premium valuations can be quickly erased if the market feels this money is ill spent, or if they spend a bunch of money on AI and it really doesn't increase the overall retention of their subscription base. Now, that said, Thomson Reuters has gone through numerous substantial corrections over the last while here, and this is just another one. It does tend to come out on top. If you look at a chart here, I'll point to numerous double-digit corrections it's gone on over the years, and it just ends up posting outstanding returns regardless of this. So if you were looking to buy this company, I would certainly say you're getting a better opportunity than you were a few months ago. I'd just be relatively cautious right now because I do think it is still pretty expensive. I do think the days of 20% compound annual returns are probably long gone, but the thing is, the company doesn't need to grow at that pace to be a market outperformer. So I wouldn't go into this company looking at a previous stock chart and thinking it's going to return you 20% annually moving forward. Growth has slowed. However, it does have the opportunity to provide some pretty strong returns if it can spend wisely in the artificial intelligence space and make its platform more attractive to clients. It is not a slam dunk buy the dip for me, but it's a situation where if somebody wanted to own this company, I certainly wouldn't blame them. It is definitely one of the best in the country. So everybody, that's it for the video. Head down below, grab that free report on the top holdings in my portfolio. I update it quite often. You'll get my top 4 holdings, my thesis on them, my overall risks, my concerns, things like that. And like the video, subscribe to the channel, head down below, comment, and let me know what company you want me to go over next. I primarily base these videos on reader and watcher feedback. And as always, everybody, stay tuned for more great Canadian content.